In the name of God, the most merciful, the most beneficent. And today's lecture, this is on CMA Part 2, Strategic Financial Management, Chapter B, and it is Topic 3 about raising capital. The raising capital is mainly talking about the term finance and can be classified as short-term finance, medium-term finance, and long-term finance. Short-term finance is mostly about working capital requirements, like maintaining liquidity at a reasonable cost and other things, which will be dealing in the next topic. And this particular topic is about medium-term finance that we are going to discuss. Our focus will be on the money raised for a period of 1 to 5 years, mostly required for major repair and modernizing of the plant and equipment, etc. Machinery, kind of these things will be covered. And long-term finance we are already covered also, mostly about debt financing and other things, whichever beyond 5 years, and that will be dealing separately. We dealt already this topic in topic 2 of this part B. So, as we said that we are dealing with intermediate term finance, term sources, whatever, that is from 1 year to 5 years. And in that, there are 4 major areas that we will be discussing, which is term loans and equipment financing loans, operating leases, and finance leases. So, term loans. Term loans are debt obligations having 1 to 10 years maturities. Actually, term loans are having up to 1 to 10 year maturity, but in the intermediate financing, we will be specifically on the term loans which are up to 5 years maturity, because beyond 5 years it is considered as long-term loans. But in this topic, we are mainly focusing on up to 5 years term loans. The primary issuers of term loans are like commercial banks, savings and loan associations, and small business administration, small business investment companies, etc. So all these parts are there. And the loan providers are getting loans, and they are called actually the borrowers. And the loan providers with a lump sum of cash upfront in exchange of specific borrowing terms. So they provide lump sum of cash for meeting the financial needs of the borrowers, borrowing companies. That we are talking about corporate companies who will be the borrowers, because we are talking about mainly focused on the corporate financing. So borrowers agree to pay the lenders a fixed amount over a certain repayment schedule. Actually, in the term loan, there are specific essential characteristics is that mainly they are coming from the bank, and it will be a fixed schedule of repayment schedule will be there, and interest can be a fixed interest or it can be a floating interest. So accordingly it will be managed. While large additions usually are financed through stock or bond issues or retained earnings, the term loans are used to finance moderate increases in assets under the following circumstances. So because the large term loans or capital structure will be used for the long-term financing, whereas the medium-term loans are used for the medium-term assets structure. So what are the circumstances that this can be used? When the cost of stock or bond issuance is prohibited by certain regulations or policies of that company set by board of directors or shareholders, or when the loan will be paid off from intermediate term earnings, when there is a revenue structure is there, and from this structure that the loan can be paid off, so it is suitable for term loans only, because we don't need long-term loans in that case. The increase in assets is intermediate term, actually. Intermediate. and rather than permanent. Permanent structure can be increased only by the long-term, cost of, by the cost of equity or bond structure. So borrowers prefer term loans because they offer more flexibility and lower interest rates. Because if they are capable of repaying, it can be paid back immediately, unlike other long-term things. And also the interest rate normally because of relatively cheaper than the long-term financing. This medium-term financing is risk is also cheaper, interest rates also cheaper. So short and intermediate term loans may require balloon payments, while long-term facilities come with fixed payments. What is balloon payments? So normally these the loans for which the interest items will be paid regularly, but the entire principal amount paid at the last, upon the maturity. So that is called balloon payments. So most loans are secured. Most of the intermediate term loans are secured. So what is secured? Secured loans are loans that are secured by a specific form of collateral, like any physical assets such as property, vehicles, or it can be liquid assets such as cash also, like maintaining some cash balances or items, some cash equivalent items, kind of things. In addition, the lenders will attach other conditions such as compensating balances on commercial bank loans, various security provisions, protective covenants like positive or negative covenant conditions put by, and default provisions that allow the lender to demand immediate repayment of the term loan when certain conditions occur. If certain conditions occur, the lenders will demand the immediate repayment of their entire loan. So this one by one we will also see in detail. Most loans are less costly than public offerings like a stock or bonds, but bit higher than the bank lending interest rates. So it is in between the public offerings of stock or bonds that cost, and term loans are cheaper, but at the same time it will be relatively higher than the normal bank lending interest rates, which is very short term items. So various security provisions that we talked about for the term loans is like assignment of payment due, assignment of portions of inventory of receivables, assignment of cash surrender values of key executive life insurance policies, liens on the borrower's inventory, receivables, property, plant and equipment. That means it will be pledged. These items will be pledged, and these will be like, for example, inventory stock. When it is sold, that amount will have to be paid back as the payment schedule. So pledges of marketable security investments held by the borrower, that can also be submitted as a pledge. So default provisions related conditions include, so like what are the conditions that it will come as a default condition where the lender can demand for the loans that they have given along with the interest. So when there is a failure of the borrower to pay interest, principal or both as specified in the loan agreement. So it will be a scheduled payment actually, sometimes principal for interest, or sometimes if it is a balloon payment arrangement, only interest will be upon schedule. If there is a delay, the borrower can if the borrower cannot meet that schedule, and it will be treated as a failure, and the lender can demand, and they can trigger that demand default clause. So if there is any discovery by the lender of financial statement misrepresentation, if there is any financial statement submitted by the borrower, if there is any misrepresentation found by the lender, they can trigger that default clause. And failure of the borrower to observe any of the covenants, that means any conditions put forth in the loan agreement, if there is any failure, that then also the default clause can be triggered by the lender. So term loans normally require that the principal be amortized, that means paid off over the life of the loan. So upon a schedule, installment, it is called maybe installment loan or monthly, quarterly, semi-annually, annually payable dues or installment loans. So it will be interest plus principal. And if it is a balloon payment arrangement, only interest paid, balloon payment, that is the full lump sum of this principal amount paid at the last schedule. Suppose a company borrow $100,000 at 9% per annum payable in 8 equal installments, the first occurring at the end of the first year. So in this case, the present value of the annuity of 8 payments at 9% equal $100,000, the annual payment is computed as $18,067. The value of 5.535 is the present value at the 9% for 8 periods. So that is the calculation that comes. The present value of the repayment of the interest at 9% for the 100,000 annually paid, and for the total number of periods. Total 8 equal installments. That means for 8 years. So this is the sample. How do we calculate on that? Bank loans. We talk about the term loans obtained from the bank, and we are talking about the many different types and different terms. That means based on the repayment schedule, like installment payments, and also whether it is a balloon payment, and also the interest, whether it is a fixed or floating kind of things. So let's see the calculation of the effective interest rate. So there is simple interest and compound interest. We will talk about one by one in detail. Simple interest is interest calculated only on the original principal amount. So this is the formula given here, and we know the interest rate, the term and the amount borrowed. We can use the following formula to find the amount of the interest that will be due. So supposing if we know the interest rate already given and the amount borrowed also, so what will be the amount of interest charge? So we apply this calculation. So the amount borrowed multiplied by annual interest rate, and that has to be divided by 365 days multiplied by the number of days available. So compound interest is interest charged on the principal plus any accumulated unpaid interest. We will see with some examples of a $10,000 loan for 1 year at 12% simple interest would require an interest payment of $1,200 per year. Simple. So if it is a simple interest every year, so every year $1,200 will be interest and it will be paid back, and the principal will be paid at the end of the maturity like a balloon payment. So the same $10,000 loan but with 12% compounded interest would have an interest cost of $1,200 for the first year. However, in the second year, the interest payment would be calculated on both the $10,000 loan and the $1,200, which was the interest for the previous year, which will be unpaid at that time until this calculation. So therefore, the interest would be $1,344, which means so 10,000 plus 1,200, which is 11,200, on which the 12% rate is applied. So this is applicable when the interest is not paid, and it will be also paid at the end of the maturity along with the principal plus the all compounded interest. In the third year, same example continue. In the third year, it will be on the 11,200 plus that 1,344, which will become 12,534, on which 12% applied. So therefore, the interest will be increased to 1,505, which will be added on that. Actually, this is simple example. In reality, a loan with compounded interest would probably require payment at least the accrued interest on an annual basis. So this is mathematically to explain the compounded interest. But actually banks practice are not like that. Maybe it will be compounded for the yearly interest calculation for some banks, some financial institution, but actually the interest payment is collected by the bank. So that is the thing, annually it will be paid. Banks do not like capitalizing unpaid interest year after year, but the interest might be compounded quarterly each year. So for quarterly they will be compounding it, which would cause the amount of interest due at the end of each year to be greater than 1200. So if it is a simple interest, it will be $1,200 in the same example. But if it is compounded interest, even though it is paid, but it will be more than the $1,200 because for each quarter it will be compounding. Quarterly it will be calculated and it will be compounded. So let's see the loans with compensating balances. If a loan has a compensating balance requirement, the borrower is required to keep some minimum balance in an account with the bank. And normally this account usually a non-interest bearing account. So there won't be any interest revenue for this balance maintained. And it gives the bank some assurance that if the borrower does not fulfill the terms of the loan, there will be some cash available to the bank that it can take to offset the amount due on the loan. Like any interest payment is delayed or principal part of the principal payment is delayed, so that they can take that, or even for the cost of that their procedures they can claim for that. Any charges they can put penalty charges as per the class, they can use this compensating balance for that. So the amount of the cash required may be a percentage of the loan obtained, or it can be a fixed amount. We'll see some examples also. This compensating balance requirement raises the interest paid by the borrower since he is not able to use all the loan funds. By an example, we will understand that even though the term for the interest rate will be discussed at certain percent, but because the borrower is maintaining a compensating balance sum, that money also blocked, so the actual interest expense for them will be slightly increased. So which we will be seeing with an example. When a company is negotiating a compensating balance with a bank, it is better to use an average compensating balance because this means that for some periods during the month, the amount in the account may be below the required amount as long as the average is above the limit. For example, if though the compensating balance stipulates some amount, let's say 100,000 or 10% of the loan amount or 20% of the loan amount, so that amount will be in that balance. But it is better that the borrower negotiate that they will maintain an average balance, which means during the period if they need some funds short term, they can use it. But before end of the month, in order to maintain the average balance, they will put back that money. So this flexible average compensating balance can then be used as a cushion for the days when cash demands are greatest and expected deposits are not received. So for these kind of things, they will be used. Equipment financing loans. So they are like loan or lease that is used to obtain business equipment, such as like office furniture, computer equipment, machineries, medical equipment, etc. Company vehicles also can be obtained through these kind of things. And they are mostly secured either by chattel mortgage or a conditional sales contract, etc. Like conditional sales contract, the seller of the equipment holds the title to the equipment until the buyer makes all of the payments stipulated in the loan agreement. That means that it will be sold at the last once the buyer repay all that things, and for the residual value it will be like a purchase for the buyer, and the seller will give the title of that goods also at the end of that maturity after taking the whatever the purchase option price. Until then, it will be the under the exclusively ownership of the seller. So business equipment may be any tangible asset other than the real estate. Examples. Okay. So like furniture, computer management and all these things, they are not real estate and other things. They are equipment, and these loans are meant for only these items. Whether buying or leasing is a better option is usually the management calculate that, and usually in the equipment financing there will be a buying option will be there. Okay, so depending on the borrower's ability to obtain a loan at favorable terms, that they will calculate whether this option is better or that the taking an alternative term loans and buying the equipment directly instead of leasing. So that can be studied. So lease financing. A lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property owned by the lessor for a specified period of time in return for stipulated and generally periodic cash payments, like rent. Any usual rent, it will be for that. An essential element of the lease agreement is that a lessor conveys less than the total interest in the property. The lessor is the owner of the property. What is that means? The property will be given to the lessee to use it, but the ownership will remain with the lessor, and he will convey only the less than the total interest, not the whole interest of that property can be used by the lessee. Lessor allows the lessee to use the asset for the specified period, only for that up to that specified period, for the consideration of lessee paying a rental or making periodical payments, which is called rent or lease payment. The lessee is the one using the property and making payments in exchange for the right to use it, and he has no ownership right. So let's compare the operating or financing leases. There are two kinds of leases. One is operating lease and financing lease. So we will see with the all the futures, understand the meaning of operating leases and financing leases with this table. So both have actually the leasing feature. The meaning is the same. A commercial contract in which the lessor lets the lessee to use an asset in lieu of periodical payments of usually up to that moment point. The meaning is the same, but the period of time and contract for, and in the operating leases it's for a small period of time, that is short term, and the financing leases usually they are for long term, for period of time, and the ownership right remains with the lessor for operating leases, and for the financing leases usually it is transferred to the lessee. So that is the difference. Here only they are financing part of the thing, only the lease agreement. And the nature of this is called rental agreement contract under the operating leases. Normally it is a loan agreement contract for the financing leases. And the operating leases, that the taking care and maintain of the assets, it is the lessor's responsibility, whereas in the financing leases, because he is taking as a loan only, so the entire assets ownership is transferred already, so it is responsibility of the lessee's responsibility. Where the risk and return. So under the operating leases, it stays with the lessor, but financing leases, it stays with the lessee. And cancellation of the contract lies on the part of the lessor, so he can cancel any time. Lies on the part of the lessee is for the financing leases, he can cancel them. Tax advantages. Even the lease rent is allowed to be deducted from the tax, because it is considered as an expenses under the operating expenses for the lessee. But the expenses for the asset such as depreciation, financing are allowed for tax deduction to lessee. So that is in the financing leases as part of the depreciation or interest payment, it can be considered. So purchasing option. the lessee is not given any such option in the operating leases, whereas in the financing of leases, it is an option for that. So advantages of leasing: flexible financing, and it is convenience for the short-term leases. It makes more sense to lease than to buy. Okay, because if any particular asset items are needed for short-term period or medium-term period, so instead of buying it and then after using it to sell it, so it is more riskier than just getting it in lease payment. 100% financing at fixed rates normally. Usually in this lease financing, loans usually require down payment. The other term loans usually require down payments. Fixed rates protects the lessee against inflation and increases in the cost of money. Protection against obsolescence, because as we saw in an example earlier just now, that instead of buying and using it and then it will become obsolete, so then again we have to sell it back. So instead of that, this kind of arrangement better. The lessee may be permitted to turn in an old piece of leased equipment for a new model at any time. So he can just return back and then take another one like that. So he can always cancel the old lease and writing a new one for the new equipment. So the cost of the new lease is added to the balance due on the old lease plus the old piece of equipment's trade-in value. So he takes on lease financing and he keep on using it, paying rent, and at the end of some time after, maybe after 10 years, 5 years, whatever the period, so then the equipment may have some residual value, but he can take back a new one with a new lease amount by changing the lease agreement, and from there he deducts the old piece equipment trade-in value, whatever the trade-in value that can be deducted, so he can take that. So without any worry, so he will continue to use a new equipment with a changed lease agreement. Expedient, as it is often avoids some of all of the time-consuming capital budget process. So in the long term, normally lot of rules and regulation, maintenance, cost of funding, cost of financing, etc. appear. But here it is expedient. Okay, we can avoid lot of that rules and regulations so that we can get that sort of financing. So what are the disadvantages of leasing? Mainly, the cost. A company with good credit opportunities may find purchasing to be more cost effective than leasing. But actually, cost is one of the disadvantages. Unless we have a good, strong credit opportunities. But at the same time, we have good credit opportunities. We can get that by purchasing also slightly with a very cost effective than the leasing options, because there will be no high price and there will be no the credit term will be available, so that we can always compare that buying, using, and then selling it back at the residual value if possible. One side, another side the lease financing, other side, and we can compare. So that if unless the borrowing company have a good credit opportunities, that this cannot be comparable. So that is one thing. And loss of flexibility. So it is not unusual for a lessor to deny the lessee the right to make changes to a leased asset, and there is often a penalty for the early cancellation of a lease. So we cannot just, supposing we have a situation that we don't want that thing, we cannot just cancel that lease. So that kind of flexibility is not there. So that is also one of the disadvantages of leasing. This is comparative. A lease may be a better option than purchase from the cash flow standpoint, or it may not be. So that is only when we put the figures on both sides to compare, and we can arrive at that kind of decisions. So in order to find that, we need to calculate net advantage of leasing. What is the net advantage of leasing comparatively? So to determine which is the better financing vehicle for a particular transaction, a cash flow analysis is a must. And we use the discounted cash flow concept, taking the present value of the future cash flow available. Let's see an example. A corporation is considering whether to lease or buy a piece of equipment. The equipment would cost $100,000 to buy. The vendor has offered to set up an operating lease instead of selling the equipment to ZMF. The lease payments would be $23,982 per year for 5 years. So 5 years into. In simple multiplication calculation, you will get that the lease payment will be more than $100,000. So it is not that way that we need to compare. Okay. So how do we calculate that? At the end of the lease, the equipment would be turned over to the lessor. So if you are paying 23,982 every year for 5 years, at the end of the lease, so the equipment will be to come to the borrowing corporation. So which is better? Now that is the question here. And there is a tax rate of 40% tax rate is there. So taking this information, if you calculate that, you will get which will be the better option, whether to buy or to get this operating lease agreement. So alternatively, the company can borrow the funds to purchase the equipment at its incremental borrowing rate of 10%. So outside market, they can buy funds. So we will see the payments of principal and interest would be due at the end of each year if the company buys the equipment, and it could depreciate it for tax purposes as 3-year property. One side we take the operating lease, paying $23,982 every year. At the end of the year, it will come back to the ownership of the borrowing company. Or alternatively, we can source finance at the borrowing rate of 10%. So there will be payment schedule, but we can have also tax benefit by depreciating that fund, and we will see what that. If we put that, in order to calculate the net advantage of leasing, both sides on one side, what we have to take it is that the after tax cash flows for the two alternatives in two sides. One is that one side we take the after tax cash outflows for purchase alternatives, and here after tax cash outflows for leasing alternative. If we lease, what will happen, and if we purchase, what will be the cash flow aspect, so that we take the net advantage of leasing, or we find that if it is minus, we should not lease it. If it is positive, we can lease it. So that's the idea of these things. So we take that kind of calculation. So we take after tax cash flows, and also taking the present value items. What is the present value of the net advantage to whichever option is most advantageous? In this table we explain the difference between the purchase option and the leasing options. So we put the first year that we pay the leasing advance payment, which is $23,586, and at the end of the year for the purchase option, it is 9,048 by calculating the interest rate at 10% financing outside, which comes to 9,048. And at the end of the first year, the payment for the leasing option will be 60% of the payment. Why? Because there is a 40% tax advantage for this leasing option. So 60% of that 23,586 every year will be $14,152. So therefore, first year, second year, third year, end of the year, it will be there. And the fifth year, the payment will be completed for the loan, which will be 25,490. But whereas the lease option 50 because every year the advance payment, so there will be options available which is a minus 9,434 because at the end of the 5th year the equipment will be transferred to the ownership of that. Here the finance will be end at the 5th year. So we take the net result of that for the net advantage of leasing. If the leasing is more, it will be plus. If it is leasing is less, it will be minus, and that will be computed with the present value table for the number of years at 6% factor. So this is the value multiplied by that. So we get the present value net assets, net advantage of leasing. So we get that it is a minus value. Therefore, because the net advantage of leasing is showing a minus value, it is preferable to purchase, not taking the loan from outside and purchase it, and not to go for the lease financing option. Convertible debt and convertible preferred stocks are other long-term sources of financing, like the debentures, unsecured bond that is convertible to the debt issuer's common stock at the debt issuer's option. And convertible preferred shares can be converted into common stock at a fixed conversion ratio. So if there is any convertible option which is within a short period of time, like for example 4 years, within 5 years, like that, so it can be treated as a medium term financing also. That is a good option for that kind of things. Once the market price of the company's common stock raises above the conversion price, it may be worthwhile for the preferred shareholders to convert and realize an immediate profit. So that is also kind of good options for this. Let's see this CMA adapted question. In a market with semi-strong efficiency, so we should understand what is semi-strong efficiency. Before that, let's read the full questions. In a market with semi-strong efficiency, investors use historical prices to predict market performance, or security prices reflect all public information, and option C, security prices reflect insider information. Option D, investors earn more on dividend paying stocks. So let's understand what is semi-strong efficiency. First of all, what is that kind of efficiency from the market side? That we have weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. Let's understand that. Then, in order to get clear response for this MCQ. Weak form of efficiency refers to a market where share prices fully and fairly reflect all past information. In such a market, it is not possible to make abnormal gains by studying past share price movements. Okay, so share prices fully and fairly reflect all past information, but it is not possible to make abnormal gains. So therefore, we will not be able to study fully about the market situation. Like for example, even insider information cannot be known for that. Semi-strong form of efficiency refers to a market where share prices fully and fairly reflect all publicly available information, in addition to all past information also available. But still, in this situation also, like kind of insider information cannot be known. And research has shown that well-developed capital markets such as the London Stock Exchange and the New York Stock Exchange are semi-strong form of efficiency. So that is the things. So we will get all information from financial press and other things, but not like company insider information and other things. Okay. But strong form of efficiency refers to a market where share prices fully and fairly reflect not only all publicly available information and also past information, but also all private information. That means all insider information also can be there. Actually, there is not much possibility of insider information yet to be revealed. so that the market, there will be no kind of big fluctuation in this, in the strong form of efficiency. So with this understanding, if we read that question, then we will get that the option B stands for the semi-strong efficiency, because security prices reflect all public information in the semi-strong efficiency. In markets with semi-strong efficiency, all public information is reflected in security prices, but not all private information is reflected in those prices, like inside information and other things also. All other options for this question are not valid, because investors use historical prices to predict market performance. That is very weak efficiency. And option C, security prices reflect insider information, that is a strong efficiency area. Here the question says about semi-strong efficiency. Okay, so option B is the sound one. Next question, an underwriting syndicate is a combination of, before we see what is that meaning of syndicate, let's read the questions. Then option A, credit rating agencies and leasing companies, C, investment banks, and D, factoring companies. So in order to understand that to select a right option, understand what is mean by an underwriting. An underwriting syndicate is a combination of investment banks. Syndicate in the sense is like a group of banks and things like that. Underwriting is the process where an investment bank agrees to buy a firm's securities and then resell the securities to other investors. Like for example, a firm want to take a loan, so they give collateral securities and they take that, and or they buy the securities like bonds or whatever debt securities, and that there is a risk also. Return also is there, and there is a risk also is there. So by syndication, this risk can be shared. So this is often done through an underwriting syndicate or group of investment banks to spread out the risk that the securities might sell below the price that was paid by the underwriters. So therefore, this is the right option, C, which is investment banks, because it is not about credit rating agencies or leasing companies or factoring companies. So the next question, the treasurer of a European company plans to raise $500 million to finance its new business expansion into Asia Pacific region. The treasurer is analyzing initial public offerings. So while he do that analyzing, so he come to conclusion that except one of the following choices, all others are correct. So A, it says under an underwritten offering, the investment bank will guarantee the sale of stock of an offering price. However, the commission charged to the company will be higher compared to best efforts offering. Yes, this is valid point for the IPO offering. An initial public offering will increase the liquidity of the company's stock and establish the company's value in the market. So that is also because of raising the funds, so it will improve the chances of liquidity of the company's stock and establish the company's value in the market also. And among the C and D, if you read that, one of the advantages of an initial public offering is that the stock price can accurately reflect the true net worth of the company after it goes public. So is that true or not? So let's read the choice D also. It is necessary for the company to file a registration statement with the SEC, Security Exchange Commission, if it decides to launch an initial public offering. This is very valid legal requirement also. Option C is not correct. Why? Because although an initial public offering can help establish the value of a company in the market, stock prices do not always accurately reflect the true value of a company. Because it is not possible that investors they don't understand or knew all the company's activities, and they are not open in the public also, public domain. So in which case the stock price may not accurately reflect the true net worth of the company. The investor who are interacting with the in the market, they don't judge with the full information. So that's why one of the advantages, that is the wrong statement, that one of the advantages of an initial public offering is that stock price can accurately reflect the true net worth of the company after it goes public. Thank you. This is end of the topic 3 of chapter B, and we will proceed to the topic 4, which is about working capital management. Thank you. Praise be to God. எல்லா புகழும் இறைவனுக்கு.